All right, let's talk about Kotak Mahindra Bank. We're looking at a really critical moment for them. This is year 3 of what's being called the Vaswani era. So in this breakdown, we're going to dig into this huge transition they're going through, the big challenges they've just faced, and where they're trying to go from here.
Okay, first up, a founder's legacy comes to an end, and this is a big one. So, you really have to get this to understand what's happening. For, 2 whole decades, Kotak Bank basically was Uday Kotak. The man and the brand were completely intertwined. But now, that's over. We're officially in the Johnny Vaswani era, which kicked off in January 2024, and the entire mission has been flipped on its head. The goal now is to go from this iconic founder-led institution to something totally different, a younger, hungrier, and completely professional digital-first giant. Next up, the regulatory catalyst. Because this change didn't just happen on its own. This whole transition wasn't some smooth, planned thing from the boardroom. Oh no, it got a huge jolt from the outside. The new leadership was thrown right into what you could only call a baptism by fire. In April 2024, the RBI, that's the Reserve Bank of India, slammed them with a massive ban. They couldn't sign up new digital customers, couldn't issue new credit cards. Why? Because their IT infrastructure just wasn't up to snuff. This forced them into a really tough corrective phase, which ended with what they're calling the big unlock in February 2025, when those restrictions were finally lifted. So what happens when a regulator forces your hand like that? Well, the bank had no choice but to go into corrective mode, and that meant pouring a ton of money into their tech. The result? They've come out of it with way better cloud resiliency and data security. But you know what's really telling? It's the way management talks about it now. They're out there saying their tech is in the best shape ever. That's not just corporate speak. That's a direct signal to the market that they've fixed a huge, glaring weakness.
All right, with that crisis in the rearview mirror, let's look at the strategy for this new era.
Okay, so what's the game plan now? It all revolves around this idea called One Kotak. What does that even mean? Well, the goal is to tear down the walls that have always separated their different divisions. Banking over here, wealth management over there, and insurance in another corner. Now, let's be real. Breaking down silos in a company this big is a massive challenge. But if, and it's a big if they can pull it off, think about what it means for you, the customer. It's a single, seamless experience where the bank sees your entire financial picture. And look, you can't have a high-tech strategy without the right people to run it, right? So Kotak is basically importing what you could call global tech DNA. They brought in a new CTO, Nilesh Chaudhari, and get this, they've created a whole new position for a head of AI. And these aren't just any hires. We're talking about veterans from places like Amazon and JP Morgan. That sends a very clear message. They're serious about competing and even leading in the age of Gen AI. Okay. So let's get to the heart of it for investors, the bull case versus the bear case. So if you're bullish on Kotak, where do you start? You start with the balance sheet. It's just rock solid. Their common equity tier 1 ratio, which is really just a key measure of a bank's ability to withstand stress, is at 21.5%. That is a huge number. Analysts literally call this a fortress balance sheet. It means they have a massive cushion to absorb any shocks to the system and plenty of firepower to go after growth. All right, the second big point for the bulls is asset quality. Take a look at their gross non-performing asset ratio. That's just a fancy term for the percentage of their loans that have gone bad. It's only 1.30%. That is incredibly low, one of the best in the entire industry. It shows they've been really smart and disciplined about who they lend money to for a very long time. And management keeps hammering this home. They're focused on quality, not just growing the loan book at any cost. So let's just wrap up the bull case. It really comes down to 3 things. 1, the whole regulatory mess with the RBI, it's over. That cloud is gone. 2, they've got fresh, world-class tech leadership calling the shots. And 3, that fortress balance sheet we talked about with a 21.5% CET1 ratio gives them a super strong foundation to build on. Okay, but every story has 2 sides, right? Let's talk about the bear case. The biggest worry here is something called CASA ratio compression. Now, CASA stands for current and savings accounts, and this ratio is basically the lifeblood of a bank. It's all that cheap money people deposit. For Kotak, that ratio has dropped from over 50% down to around 42%. And to be fair, this isn't just a Kotak issue. There's a full-on deposit war happening across India right now, with every bank scrambling for these low-cost funds. And when it gets harder to get cheap deposits, well, that hits your profitability. It's a direct line.
And that's exactly what we see with their net interest margin, or NIM. It's squeezed, down from a peak of 4.9% to 4.54%. So what's causing this? It's really a double whammy. On one hand, they have to pay more for deposits because of that deposit war. On the other hand, they're spending a fortune on their big tech overhaul. Both of those things eat into margins.
So to sum up the bear case, it's also built on three main points. First, that NIM compression we just discussed. Second, execution risk. Can they keep this new tech leadership in place and actually deliver on the strategy? And third, those relentless deposit wars that aren't going away anytime soon. So where does that leave us? Let's talk about the verdict. A spring-loaded setup. This is where it gets really interesting, because you have to look at the valuation. For years and years, Kotak was the premium bank. It always traded at a high price. Not anymore. Right now, it's trading at a historic discount. Its 5-year average price to book was 3.5 times. Today, it's just 2.3 times. That's a huge gap, and it tells you a lot about how the market is thinking. So this all leads to what some are calling a spring-loaded setup. Think of it like a compressed spring, just waiting to expand. The view is that Kotak is a great long-term compounder that's just going through a period of consolidation. It's fixing its issues. And that lower valuation, that 2.3 times price to book, it gives investors a margin of safety, a bit of a cushion that you just didn't have for the better part of the last 10 years. So what's the roadmap from here? Well, the market is looking out to fiscal year 2027 for a full-on rebound. The thinking is after they finish the cleanup in FY26, maybe even do a stock split, their rebuilt credit card business will start to really kick in and drive earnings. Management is aiming high, targeting a return on assets of over 2.2%. But of course, the big question is still out there. Can this new professional team actually execute on this ambitious plan and, finally step out from under the massive shadow of its founder?